And now in Wake Up Money, in the aftermath of Hurricane Ike, many people have learned that their insurance does not cover the entire cost of their losses. But you just may be able to get some financial help from the IRS, believe it or not. Certified public accountant Bob Martin is back now to explain all of this. Good morning, Bob. Thanks for joining us. All right, you've got some damage because of Ike. Your insurance has paid some of it, but not all of it. How do you turn to the IRS for help?
Well, the IRS allows you to deduct casualty losses in excess of your insurance and other reimbursements. And so I've set up a simple example here. For example, someone had a property that was worth $100,000, and after the storm it was only worth $20,000, so they have a potential loss of $80,000. And so if their insurance only paid $50,000, they're still out $30,000. I mean, this is a real loss that they've had. And fortunately, the IRS recognizes this and allows you to take a deduction for that $30,000. Now, there are certain limits. For example, your level of income is going to limit that. And in my particular example, it reduced it by $6,000. But that left the person with a $24,000 loss, which is really amazing. If they're in a 25% bracket, they're going to get an additional $6,000 from the Internal Revenue Service.
Now, can they file their, when they get their money back, is it based on the 2007 return or the 2008 return, or either one?
Well, actually, it's either one. There's an interesting provision in the law that even though the casualty was in 2008, this year, you can go back and amend your 2007 tax return. So you take your 2008 loss in your 2007 tax return. Now, a lot of people have already filed their 2007 tax return, so they can file an amended return. And in my example, the person might be getting a $6,000 refund, and through the amended return, they can get that $6,000 within 4 to 6 weeks. Now, also, there are people who are falling under the extension. The IRS did grant an extension for people till January 5th of next year to file their 2007 returns. So if you haven't filed your 2007 return, you have a casualty loss, you may want to look at taking it in that tax return that you haven't filed.
Just real quickly, we've got a couple of minutes, a couple of seconds. Should they go to an expert, or should they try to figure this out themselves?
I would recommend that they might want to draft up the information, but this has been a very simple example. There are a number of traps. If they had business property, say a home office, they really do need to talk to someone.
Okay, Bob, appreciate it. Thanks for coming in again this morning.